What if the secret to building real wealth wasn't about chasing the next hot stock, having a high IQ, or predicting the future? What if the smartest move you could make was simply learning how to control your emotions? The Intelligent Investor by Benjamin Graham isn't just another book on investing. It's the Bible of long-term wealth building. And according to Warren Buffett, one of the richest men alive, this is by far the best book on investing ever written. But here's the thing. Most people never finish it. Even fewer understand how to apply it. In this summary, we've taken Graham's timeless lessons on risk, discipline, market madness, and the mindset of a true investor, and turned them into a clear, powerful journey you won't want to miss. If you truly want to protect your money, grow it wisely, and think like the best investors in the world, listen till the end, because by the time we're done, you won't just understand the market, you'll understand yourself. Introduction. What makes an investor truly intelligent? When you hear the term intelligent investor, what comes to mind? A math genius? Someone who can predict stock prices like magic? According to Benjamin Graham, the legendary investor and author of The Intelligent Investor, that's not what intelligence in investing means at all. In Graham's eyes, intelligence has less to do with IQ and more to do with emotional control, patience, discipline, and the courage to think for yourself. An intelligent investor is someone who doesn't get swept away by the highs of market euphoria or crushed by the lows of panic and fear. It's someone who sticks to principles even when the crowd is screaming in the opposite direction. To understand this better, let's turn to a surprising story from history, one involving none other than Sir Isaac Newton. Yes, Newton, the man who discovered gravity and reshaped science forever, once dabbled in the stock market. In the early 1700s, he invested in the South Sea Company, a wildly popular stock in Britain. At first, he played it safe. He sensed the bubble forming, sold early, and walked away with a handsome profit, doubling his money. But just months later, he saw others getting rich and couldn't resist the temptation. He reinvested, this time at a much higher price. And when the bubble burst, Newton lost a fortune. Later, he famously said, "I can calculate the motions of heavenly bodies, but not the madness of men." Despite his brilliance in science, Newton lacked the emotional discipline needed for investing. That single episode became a classic example of what Graham warns us about. Intelligence in markets is not about cleverness, it's about temperament. Before Benjamin Graham, investing was more like gambling. People relied on tips, rumors, and gut feelings. There was no structure, no method, just chaos. But Graham changed that forever. He introduced rational principles and long-term thinking, turning investing into a science rooted in logic and safety. But Graham's own journey wasn't easy. He was born in London in 1894 into a wealthy family. His father dealt in fine Chinese porcelain. But soon after they moved to New York, tragedy struck. His father died, the business failed, and the family lost everything. Once living in a luxurious Fifth Avenue home, they were suddenly forced to take in boarders just to survive. Graham's mother tried to recover their fortune by investing in stocks, but the market crashed again, wiping out what little they had left. One day, young Benjamin went to the bank to cash a small check. The teller questioned whether his mother even had enough balance. That moment, that sting of embarrassment, lit a fire in him. He worked hard, won a scholarship to Columbia, and graduated at the top of his class. At just 20, he received offers to teach at multiple departments, but he had bigger ambitions. He set his sights on Wall Street. Starting as a lowly clerk, he climbed the ladder, analyst, then partner, and eventually founder of his own firm, Graham Newman Corporation. Over 2 decades, his firm averaged nearly 15% annual returns, an incredible achievement, especially surviving the Great Depression. His success wasn't based on speculation or luck. It came from deep analysis, discipline, and a relentless focus on minimizing risk. And it's exactly that wisdom he poured into The Intelligent Investor, a book that teaches not just how to make money, but how to avoid losing it. Published in 1973, the book remains a timeless guide. Its core principles still apply in today's fast-paced, digital investing world. No wonder Warren Buffett, one of Graham's students, calls it by far the best book on investing ever written. So if you're tired of get-rich-quick schemes and ready to build true financial strength, this book and this summary is your starting point. Investment versus speculation. Knowing the difference could save you a fortune. Have you ever wondered why stockbrokers on Wall Street cheer when the market closes for the day, regardless of whether stocks went up or down? The answer is simple. Whether you make money or lose it, they still get paid. This brings us to a crucial lesson from Benjamin Graham: the difference between being an investor and being a speculator. It's not just about what you buy. It's about how and why you buy it. Speculators are like gamblers in a casino. They bet big, chase high risks, and hope for lucky wins. Sometimes they hit the jackpot, but most of the time they walk away with losses. Meanwhile, the house, in this case, the brokers and trading platforms, keeps raking in profits, trade after trade. So, how do you know if you're investing or just speculating? According to Graham, a real investor follows 3 simple but powerful principles. 1. They study the company carefully before buying any stock. They look at the business model, financials, leadership, and industry trends. 2. They avoid unnecessary risk. They don't chase flashy promises or fall for hype. 3. They aim for reasonable, consistent returns, not overnight miracles. If you stick to these rules, you're far more likely to grow your wealth steadily, while avoiding the emotional roller coaster that wrecks many portfolios. You'll make money for yourself, not just for the brokers who earn commissions on your trades. Speculators, on the other hand, often act on gut feeling, public hype, or a hot tip. They react impulsively, hoping to get rich quickly, and while they may see short-term gains, those rarely last. In contrast, true investors build long-term, sustainable success step by step, year by year. Today, though, speculation is more common than ever. Thanks to online trading and mobile apps, buying and selling stocks has become as easy and as addictive as playing a video game. Social media, television, cafes, and even dinner tables are filled with buzz about stocks. Everyone seems to have an opinion, but few have true knowledge. The problem isn't a lack of information. It's the lack of understanding. People are drowning in data, but starving for wisdom. They treat stocks as symbols on a screen, blips to be bought and sold, without ever learning what the companies actually do. For many, the name or ticker is enough, and that's dangerous. There's a famous example from 1998 that proves the point. A small, obscure company called Temco Services suddenly saw its stock price triple in just minutes. Why? Because traders confused its ticker symbol, TMCO, with that of a completely different company, TMCS, which belonged to the newly IPO'd and highly popular Ticketmaster Online. Investors jumped in, thinking they were buying into the next big tech success, but they weren't. They were blindly clicking buy without even taking 2 minutes to verify the company. That's not investing. That's gambling. Another lesson from Graham is about mindset. Would you be comfortable not checking stock prices every day? If the answer is yes, you're likely thinking like a true investor. Intelligent investors focus on the long-term value of the business, not on daily price swings or market noise. That detachment helps them stay calm and avoid herd mentality. Consider what happened with Amazon back in 1998. A financial analyst at CIBC, Henry Blodgett, projected that Amazon's stock could go from 150 to 400 within a year. That single statement triggered a 14% jump in the stock on the same day. The market surged, not because of company performance, but because of one analyst's opinion. What's more, even though Blodgett meant his target was for the next 12 months, investors rushed in, and the stock hit that target in just a few weeks. This kind of behavior, rushing in on hype without doing proper research, is exactly what Graham warns against. Intelligent investing is about logic, discipline, and a long-term view, not emotional reactions to headlines or predictions. So ask yourself, are you thinking like a casino player, or are you thinking like a business owner? Because in the long run, it's not luck that builds wealth, it's wisdom. A century of stock market history. Why past returns can be deceptive. In the late 1990s, many so-called experts confidently declared that the stock market was a reliable, money-making machine. They pointed to historical data going back to 1802, claiming that stocks had returned an average of 7% annually for nearly 2 centuries. Their conclusion? Investors could safely expect similar returns going forward, but Benjamin Graham warned against this kind of thinking. He believed that blind trust in the past was not just naive, it was dangerous. According to Graham, the stock market doesn't follow a fixed pattern. It doesn't owe anyone guaranteed returns. And history, while useful for context, cannot be used as a crystal ball to predict the future. Unfortunately, many investors in the 1990s ignored this advice and paid the price. Let's look at some real examples. In 1999, Kevin Landis, a manager at First Hand Mutual Funds, appeared on CNN. When asked whether wireless telecom stocks were overvalued, he confidently replied no. He believed the industry was booming and would continue to grow rapidly. A year later, those same investments collapsed. Landis lost 67% on Nokia and an astonishing 99% on Winstar Communications. Around the same time, Robert Froelich, a strategist at Kemper Funds, told the Wall Street Journal that people shouldn't fear companies with soaring stock prices. According to him, high prices were justified because these companies had visionary leadership and massive potential. The result? Froelich saw losses of over 70% on giants like Cisco and Motorola. In fact, Cisco shareholders collectively lost around $400 billion in market value. Then there was Jeffrey Applegate from Lehman Brothers. In a 2000 interview with Businessweek, he insisted that rising stock prices didn't necessarily mean higher risk, but the numbers told a different story. At the time of his comments, the Dow Jones Industrial Average stood at 11,000 and the NASDAQ at 4,400. Within just 2 years, the Dow dropped to 8,000 and NASDAQ plunged to 1,300. These were not isolated misjudgments. They were warnings ignored. The lesson? The more certain people become about future returns, the more fragile their assumptions tend to be. This is why Graham emphasized realistic expectations. The intelligent investor doesn't throw money at overhyped companies or assume that high past returns will continue forever. There is always a limit, both to a company's ability to grow and to the price investors should be willing to pay. To understand this, Graham uses a simple analogy: Michael Jordan. Jordan was, without question, one of the greatest basketball players in history. When he played for the Chicago Bulls, the team gained immense popularity and success. The Bulls paid him a well-deserved $34 million per year during his prime. But imagine if they had decided to pay him $340 million or $3.4 billion or even $34 billion. That would be absurd, even for someone of his legendary talent. Likewise, no matter how brilliant a company is, there's a point beyond which its stock price becomes irrational. Paying too much, even for a great business, guarantees disappointment. Graham's core advice is timeless: buy low and sell high. Yet in reality, most people do the opposite. They get excited when prices are soaring and panic when prices fall. They buy high and sell low, led not by logic, but by emotion. So the next time you hear a market expert sounding overly confident, remember the rule of opposites. The more optimistic the forecast, the more cautious you should be, because the intelligent investor doesn't chase returns based on hope or hype. They rely on discipline, patience, and an understanding that while history offers lessons, it never offers guarantees. General portfolio policy: finding the right balance for you. There isn't just one way to be an intelligent investor. In fact, Benjamin Graham says there are two equally valid paths, and your choice depends more on your personality than your age, income, or background. The first is the active approach. Think of this like a competitive sport. If you're the kind of person who enjoys constant challenge, analysis, and strategy, who likes to stay updated with the market, review companies, and make decisions with precision, then active investing might be for you. It requires time, focus, and consistent effort. The second is the passive approach. This is for those who prefer simplicity and stability. If you'd rather not check your investments every day and you're comfortable with a more hands-off style, then passive investing is a better fit. It involves building a well-diversified portfolio and letting it grow quietly over time, without being caught up in the daily drama of the market. Here's the key: both approaches are intelligent. What matters is choosing the one that aligns with your temperament. Are you drawn to movement and momentum, or do you thrive in calm and consistency? Once you've identified your investing style, the next question is, how should you divide your money between stocks and bonds? Now, many financial advisors will tell you to follow a simple age-based formula. Subtract your age from 100, and that's the percentage of your portfolio that should go into stocks. So if you're 28, invest 72% in stocks. If you're 81, invest only 19%. But Graham rejects this kind of one-size-fits-all advice. According to him, your age doesn't define your financial wisdom. Your mindset and circumstances do. Instead, he offers a more thoughtful rule. Keep at least 25% of your portfolio in bonds at all times. Why? Because the stock market is unpredictable, and so is life. Having a foundation in bonds provides a buffer when things get rough. Let's compare two very different investors. First, there's Mrs. Smith, an 85-year-old widow. She receives a steady pension and has $3 million in the bank. She wants to leave something for her grandchildren, but has no major financial worries. Then there's John, a 25-year-old bank employee. He's saving up for a wedding and planning to buy a house. His income is modest, and his financial future is still taking shape. Based on age, you might assume Mrs. Smith should invest conservatively, and John should take more risks. But look closer. Mrs. Smith has security, stability, and surplus. John, meanwhile, needs to protect what little he's saved. According to Graham, this means Mrs. Smith can afford more risk, while John should play it safer. It's not about age, it's about your financial foundation, your responsibilities, and your goals. So ask yourself, do you have a stable income? Are you saving for major life changes? Can you afford to lose part of your capital without affecting your lifestyle? If your situation is stable, like Mrs. Smith's, you might allocate 75% to stocks and 25% to bonds or cash. But if you're still building your financial base, like John, you might do the reverse, 75% in bonds or cash and 25% in stocks. And here's another powerful point Graham makes. Don't let market trends dictate your actions. Just because stock prices are rising doesn't mean you should buy more. True intelligence lies in discipline, not excitement. Instead of reacting to price movements, focus on your actual financial needs. Are your investments aligned with your long-term goals? Are they realistic for your current life stage? To stay grounded, Graham recommends reviewing your portfolio every 6 months. Not daily. Not every time there's news. Just twice a year. That's enough to keep things on track without getting swept away by emotions or hype. In the end, being an intelligent investor isn't about beating the market every day. It's about building a strategy that fits your life, sticking to it, and letting time do its work. The defensive investor and common stocks. Playing it smart without playing it risky. Not every investor wants to dive headfirst into the fast-paced, unpredictable world of the stock market. Some prefer a quieter, more stable approach, one that focuses less on chasing profits and more on protecting what they already have. That's where the defensive investor comes in. A defensive investor understands that the stock market is risky by nature, but instead of avoiding it entirely, they look for sensible ways to participate, strategies that allow them to grow their money without exposing themselves to unnecessary danger. Since bonds often deliver low returns, owning some carefully chosen stocks can be a smart way to balance things out, as long as it's done wisely. One of the most powerful strategies for the defensive investor is to build what Benjamin Graham calls a permanent autopilot portfolio. This means selecting a group of reliable, well-researched stocks that you hold for the long term. Once chosen, you don't keep switching them in and out. You simply let them work for you over time. It's a calm and disciplined approach designed to reduce stress and increase long-term stability. But before building this kind of portfolio, there's one golden rule you must follow. Do your homework. That means learning about the companies you invest in, read their financial reports, understand their business model. Don't just buy a stock because it feels familiar. As Peter Lynch, famed manager of the Fidelity Magellan Fund, once said, use what you know. If you notice a coffee shop that's always packed or a product that everyone's raving about, that could be a clue that the company is doing well. But let's be clear, familiarity alone is not enough. A perfect example is the famous singer Barbra Streisand. In 1999, she mentioned that she drinks Starbucks every day, so she bought its stock. That kind of thinking is common. Many people invest in companies simply because they like the brand, the service, or the product. Some buy Amazon stock because they shop there, or invest in E-Star Trade because it's their favorite trading platform. Others put their money into a mutual fund company just because they drive past its office every day. But this kind of thinking is lazy investing. Just because something is familiar doesn't mean it's financially healthy. In fact, being too familiar with a company can blind you to its weaknesses. It creates a false sense of confidence. You stop asking tough questions, and that's when mistakes happen. If you're truly a defensive investor, you must go a step further. Know the numbers, check the company's earnings, debt levels, and long-term prospects. Trust your research, not just your feelings. Now, if you're ready to invest wisely, here are a few practical tips to make things easier and more cost-effective. Use low-cost online brokers. Platforms like ShareBuilder and Folio FN, or their modern equivalents today, offer affordable trading options, sometimes as low as $4 per transaction. Many require no minimum balance, and you can automate deposits directly from your bank account. Reinvest your dividends. Instead of cashing out your earnings, reinvest them to buy more shares. Over time, this helps you benefit from compounding, a powerful tool for building wealth gradually. Consider buying stocks directly from companies. Some corporations offer direct stock purchase plans, DSPPS, which let you invest without using a broker at all. It's simple, efficient, and avoids extra fees. Look into mutual funds. If you prefer a fully hands-off approach, mutual funds are a solid option. They offer built-in diversification, professional management, and usually lower risk than individual stocks. They're designed for investors who want to participate in the market without constant monitoring. In the end, being a defensive investor doesn't mean avoiding the market. It means approaching it with care, logic, and patience. It means focusing on long-term value, not short-term excitement. So whether you're just starting out or want to protect your hard-earned savings, remember this: you don't have to be bold to be brilliant. You just have to be smart. Portfolio policy for the enterprising investor. What not to do. There's a common temptation among eager investors to treat the stock market like a fast-paced game, buying and selling rapidly, hoping to catch quick profits. This is what we call day trading, the act of holding stocks for a very short period, sometimes just hours or even minutes. Sounds exciting, right? But according to Benjamin Graham, it's actually the fastest route to financial disaster. Yes, day traders may score a few small wins, but over time, most of them lose far more than they gain. Why? Because the system isn't built in their favor. The one who consistently profits from day trading isn't the trader, it's the broker. Here's how it works. Day traders are constantly on edge, always ready to buy or sell. But this emotional excitement often leads to poor decisions. They end up buying when prices are high, driven by fear of missing out, and selling when prices drop, driven by panic. This buy high, sell low pattern is the opposite of intelligent investing. And that's just the start. Every time you make a trade, your broker charges a fee. But beyond these visible costs, there's another hidden cost called market impact. Let's say you're desperate to buy 1,000 shares quickly. In your rush, you agree to pay just 5 cents more than the listed price. That tiny premium, it costs you an extra $50 on that one transaction. Now imagine doing that again while selling. You want to exit fast, so you accept a slightly lower price, again, losing money without even realizing it. To understand this better, imagine your investment as a solid block of wood. Every time you make an impulsive trade, buying too quickly or selling too fast, it's like rubbing sandpaper on that block. Each time, a small layer gets shaved off. You might pay 4% extra when buying and lose another 4% when selling. Just like that, 8% of your investment is gone, not because of the market, but because of your impatience. So here's a truth most won't tell you. Doing less often earns you more. There's a popular saying in life, don't just stand there, do something. But when it comes to investing, Benjamin Graham flips that idea on its head. For the intelligent investor, the motto should be, don't do something, just stand there. Instead of chasing trends, reacting to headlines, or checking your portfolio every hour, you'll do far better by holding quality investments long term. That's where real wealth grows, not in the noise of day-to-day fluctuations, but in the quiet strength of patience and discipline. So if you're thinking of jumping into day trading for quick wins, pause. Ask yourself, am I investing? Or just gambling? Because an enterprising investor doesn't rush. They research, they plan, and most importantly, they wait. Portfolio policy for the enterprising investor, the smart way to buy low and sell high. Everyone wants to follow Benjamin Graham's golden rule: buy low, sell high. It sounds simple, right? But in reality, it's one of the hardest things to do, especially when it comes to popular, high-performing companies. Think about it. We're all drawn to big names. Companies like Home Depot, General Electric, and Sun Microsystems were some of the biggest stars in the late 1990s. Between 1995 and 1999, they were exploding with growth. Home Depot and Sun Microsystems doubled their revenue and tripled their earnings per share. General Electric wasn't far behind, posting a 29% increase in revenue and a 65% boost in earnings per share. With growth like that, it's no wonder everyone wanted a piece of them. But here's the catch. As these companies grew, so did their stock prices, and often faster than the company's actual performance. Eventually, the price you'd have to pay for a share became so high that even strong business results couldn't justify it. And that's where many investors got burned. They paid a premium for hot stocks and were disappointed when their returns didn't match the hype. This brings us to one of Graham's most important insights. A great company is not automatically a great investment, especially if you're paying too much for it. Why? Because of something we can call financial physics. As a company gets larger, its rate of growth naturally slows down. A small $1 billion company might double its sales in a year by entering new markets or launching a hit product. But a $50 billion company? It would need to add another $50 billion in revenue to double, and that's a much harder climb. The law of large numbers kicks in, and the higher the mountain, the tougher it gets to keep climbing. So how can an enterprising investor still grab shares of top-tier companies without overpaying? Here's the smart strategy. Wait for temporary trouble. Every once in a while, even the biggest and best companies hit a rough patch. A scandal, a lawsuit, a failed product launch. These events cause public doubt and drive stock prices down. But often, these are short-term setbacks, not signs of permanent failure. Take the case of Johnson & Johnson. In 2002, the company came under investigation for alleged false record-keeping at one of its factories. That news was enough to spook the market. J&J's stock dropped 16% in a single day. To most investors, that looked like a red flag, but to an intelligent investor, it looked like a rare opportunity. This was a company with decades of strong fundamentals, global presence, and trustworthy leadership. A temporary dip in stock price, caused by a problem that could be resolved, meant you could own a piece of a world-class business at a discount. That's the secret. Don't chase hype. Don't buy when everyone else is excited. Wait for moments of doubt when a great company becomes briefly unpopular. Then, while others are selling in fear, you buy with confidence, backed by your research and long-term perspective, because the enterprising investor doesn't panic when others do. Instead, they prepare, they observe, and when the time is right, They act. That's how you truly buy low and sell high. The investor and market fluctuations, mastering the market's mood swings. The stock market is like a living creature. It breathes, it reacts, it gets emotional. The ups and downs you see every day on trading screens, those sudden rises and dramatic drops, are what we call market fluctuations. Benjamin Graham, however, had a bold suggestion. Ignore them. Not because they're unimportant, but because they're often misleading. These fluctuations reflect the emotions of the crowd: fear, greed, panic, excitement, not the true value of a company. And if you let them influence you, you'll make poor decisions. Let's take a real-world example. Inktomi Corporation. In 1998, Inktomi was one of the hottest tech stocks on the market. In just 18 months, its stock price soared by nearly 1,900%. By March 2000, a single share cost $231.62. On the surface, it seemed unstoppable. Investors were pouring billions into it. Why? Because sales were growing rapidly, $36 million in a single quarter. But here's what most people ignored. Inktomi had never made a profit. In fact, in that same quarter, it lost $6 million. 2 months before that, it lost another $24 million. It had racked up consistent losses year after year. Still, by 2000, investors had assigned it a market value of $25 billion. And then, the bubble popped. Within 2 years, Inktomi's share price plummeted to just 25 cents. Its market value collapsed to $40 million, even though its revenue had grown to $113 million. So what happened? Nothing fundamental, just a change in the mood of the market. In 2000, investors were euphoric about tech startups. By 2002, the hype had turned to fear. The pendulum swung from optimism to pessimism, and Inktomi got crushed in between. This is exactly the kind of situation Benjamin Graham warned about. While the crowd was selling Inktomi in fear, Yahoo stepped in and bought the company for $1.65 per share. Yahoo acted with reason, not emotion. It saw the long-term value others couldn't. That's what Graham meant by this timeless advice. Buy from pessimists and sell to optimists. So now that you know how bipolar the market can be, the question is, will you let its moods control you, or will you control your own behavior? In 1999, tech stocks were all the rage. People were lining up to buy shares in internet companies, hoping to strike gold. Meanwhile, strong, stable, old economy companies like Gillette, Coca-Cola, and the Washington Post were being ignored. Their stock prices had dropped by nearly 25%. An intelligent investor wouldn't chase the overhyped tech stocks. They'd recognize the opportunity hiding in plain sight, great companies at bargain prices. Why gamble on a tech startup when you can own Coca-Cola for a discount? Graham's message is clear. Don't let the market guide your decisions. Let your decisions guide your market activity. There are many things you can't control in investing, like stock prices, inflation, or market trends. But there are 5 critical things you can control. 1. Your expectations. Be realistic about your returns. Don't expect miracles. 2. Your risk. Decide how much you're willing to invest, when to invest, and where. 3. Your costs. Trade patiently and rarely to keep brokerage fees low. 4. Your tax burden. Hold investments for at least 1 year to reduce capital gains taxes. 5. Your behavior. This is the most important. Don't follow the herd. Don't buy when everyone's excited, and don't sell when everyone's scared. A truly intelligent investor doesn't need to check stock prices every day. They don't panic over every dip or celebrate every rise. Instead, they buy periodically from a pre-selected group of companies, regardless of market mood. And they sell only when truly necessary to pay for a home, a medical emergency, or a child's education. Above all, an intelligent investor is in it for the long haul. They're prepared to hold their investments for 10 years or more, ignoring the noise and trusting their own judgment, because the market will always fluctuate. But your success depends on whether you do. You've now learned what it truly means to be an intelligent investor. You've explored the dangers of speculation, the traps of day trading, and the emotional swings of market fluctuations. You've learned how to build a solid, long-term portfolio and why patience, discipline, and independent thinking matter far more than following the crowd. You've seen that the smartest investors don't try to time the market. They prepare for it. They don't chase trends. They stick to principles. And they don't panic when things go wrong. They stay calm, focused, and informed. Above all, you've seen that your financial outcome is in your hands, not in the hands of brokers, trends, or market predictions, but in the daily decisions you make. The power to grow your wealth, protect your future, and build financial freedom lies within you. Choose to think differently. Choose to act wisely. Choose to become an intelligent investor. Thank you for listening. If this summary helped you think more clearly about your money, your mindset, or your future, share it with someone who needs it. Which insight stuck with you the most? Let us know in the comments below. We'd love to hear your biggest takeaway. And don't forget to like, subscribe, and hit the notification bell so you never miss out on powerful ideas that can change your life. Until next time, stay disciplined, stay focused, and stay intelligent.